Well, it's not that a harder fall is guaranteed, but it's important that we don't get overly excited right now. It's great to see green on the screen after such a rough year last year, where it was one of the top 5 worst markets in almost 100 years. But despite the good CPI report today, we have to remember there's still a long way to go. The wages and services component of CPI is the stickiest component. That's where it's going to require the most amount of work. So the Fed is going to continue to raise rates, and they know the lessons of the 1970s. So they're going to err on the side of raising too much rather than declaring victory too early. And if the Fed is successful with winning the battle with inflation, what are we then left with is the economic slowdown and recession. How bad is that? What is the impact going to be on earnings? And that could be the next major headwind for the markets. So it's important not to declare victory too early right now.
One of the things that I think is interesting in my notes from your earlier conversations with one of our producers is that you say higher rates will shift flows from equities to fixed income. Basically, that feels to me, I read a piece from Howard Marks a couple of days ago. This feels like an epochal change in investing. For the past decade or more, bonds were not investable. You got no return for doing that. Now you're getting to a point where there is a normalization, let's call it, of interest rates, and so fixed income looks much more investable.
It's going to be a major regime shift, Tyler, and it's going to be generational, right? We've had a decade. So that means a generation of investors have come to the market where putting money in their savings account or buying bonds have done nothing for them. So we used to say, Tina, there is no alternative but equities. Well, now there are alternatives. So the equity market is going to have to adapt to that. And one of the major areas that you're going to see that adaptation is around equity market valuations. Equities are going to have to provide more in the realm of earnings and profitability in order to garner those types of valuations that they saw in the past. So the types of stocks that are going to do well when fixed income is an actual option are going to be different than those that did over the last 10 years. So you're going to see a bigger shift into value, into areas of the market where potentially they're growing a little bit less, a little bit more steady, a little bit slower, but where there's greater earnings profiles today.
That's very interesting, and that sort of agrees with what Howard Marks said. I don't want to put words into Mr. Marks's mouth. Far from me to do that, but that the idea is that the kinds of stocks that will excel in this there is an alternative world, will be qualitatively different from what worked in the past, the high growth, high beta kinds of names.